Microsoft's revelation that its commercial demand backlog has surged to an eye-catching $625 billion, roughly double what it was just a few years ago, highlights both the extraordinary momentum generated by its partnership with OpenAI and the growing unease among investors about the cost of sustaining that momentum in an increasingly competitive AI-driven landscape. The backlog figure, which represents contracted future revenue yet to be recognized, underscores how deeply Microsoft has embedded itself into the digital infrastructure plans of enterprises, governments, and developers worldwide, many of whom are racing to integrate generative AI capabilities into their operations through Azure cloud services and OpenAI-powered tools like Copilot. Executives have pointed to explosive demand for AI workloads, cloud migration, and data services as core drivers of the backlog expansion, framing it as proof that Microsoft is winning the early phases of what could be a multi-decade technology shift. Yet the same earnings report that showcased this staggering backlog also revealed why markets reacted nervously. Capital expenditures are ballooning, operating margins face pressure, and revenue growth, while still robust by most standards, shows signs of deceleration compared with the breakneck pace investors had come to expect. Microsoft is spending tens of billions of dollars annually to build and expand data centers, acquire advanced chips, and secure the energy and cooling infrastructure needed to support AI training and inference at scale. And while management insists these investments are essential to defend long-term leadership, Wall Street is increasingly sensitive to near-term profitability trade-offs, especially in an environment of higher interest rates and more selective capital markets. The OpenAI partnership sits at the center of this tension, acting simultaneously as Microsoft's greatest growth catalyst and its most capital-intensive bet, since running large language models requires enormous compute resources that translate directly into higher costs before revenues fully catch up. While Copilot subscriptions, Azure AI services, and enterprise licensing deals are adding incremental revenue streams, some analysts worry that pricing pressure, competitive offerings from rivals, and customers' gradual adoption curves could stretch the payback period on these investments longer than initially hoped. This concern is amplified by signals of slower overall revenue growth in key segments such as cloud, where Azure's expansion, though still strong, has moderated from previous peaks, prompting questions about whether AI-driven demand can offset broader enterprise spending caution amid macroeconomic uncertainty. Investors are also scrutinizing how much of the backlog will convert into high-margin revenue versus lower-margin infrastructure commitments, noting that not all backlog dollars are equal in terms of profitability or timing. Microsoft's leadership has tried to reassure the market by emphasizing disciplined capital allocation, long-term contracts, and the strategic advantage of being the preferred platform for AI development, arguing that scale itself will eventually drive efficiency gains and margin recovery. They point out that few companies have the balance sheet strength, ecosystem reach, and software integration capabilities to monetize AI as comprehensively as Microsoft, which can bundle AI features across Windows, Office, Dynamics, GitHub, and Azure, thereby spreading costs and deepening customer lock-in. Still, skeptics counter that the AI arms race could compress returns across the industry if hyperscalers overbuild capacity or if customers demand lower prices as AI becomes commoditized. There is also the question of regulatory scrutiny and ethical considerations surrounding AI deployment, which could add compliance costs or slow adoption in certain sectors, further complicating the revenue outlook. In this context, the market's mixed reaction reflects a classic growth versus profitability debate. Microsoft's $625 billion backlog is a powerful symbol of future demand and strategic relevance, but it does not automatically guarantee smooth earnings growth in the near term. The stock's volatility following the announcement suggests that investors are recalibrating expectations, shifting from unbridled enthusiasm about AI-driven expansion to a more nuanced assessment of execution risk, cost discipline, and the pace at which AI investments translate into sustainable cash flow. Ultimately, Microsoft's challenge will be to prove that its massive spending today is laying the foundation for durable, high-margin growth tomorrow, turning its OpenAI-fueled demand surge into a long-term competitive moat rather than a costly sprint that tests investor patience, a balancing act that will likely define the company's narrative and its valuation for years to come.